Yeah, I was like, okay, let's just go. Oh, we're live. Okay, hi guys, we're actually live. If you can see us, please let us know. I know it's like not necessarily in the most normal setting. Today we have two amazing guests. Why don't we start with Dave introducing yourself, and then
yeah, thanks, Grace. First of all, I wanted to thank Middleware for hosting us in their office. We're sitting in their beautiful office in FiDi, which is great. I'm Dave Anderson, one of the founding GPs of Beat Ventures. Beat Ventures is an early stage pre-seed and seed focused fund. Sure.
I want to make sure we're all TikTok ready.
Yeah. So yeah, Beat Ventures is an early stage pre-seed and seed focused firm. Focused on investing in founders building an AI, specifically for legacy industries like meat processing, oil and gas, and chemicals. We've been around for 3 years. We've got a portfolio that's growing. It's already at 18, and we're looking to make new investments. So that's us.
Hi, I'm Erasmus Elsner. Some of you might know me from my podcast and content creation studio, Sand Hill Road. Today we're here in downtown San Francisco. I'm a San Francisco-based investor. I have started and incubated a lot of companies, and currently looking at the AI space in particular the infra space. And everybody who's been to any AI meetups here, I've attended about 250 in the last 12 months. So you've probably seen my face. And
You've probably seen his face.
That's more than me.
I know. It's my.
That's crazy. And I feel a little left out. I'm the only one that doesn't have the green lanyard because I wasn't at TechCrunch Disrupt this morning. So
yeah, free shout out to TechCrunch people. Free shout out to Karat. Well, thank you so much for inviting me to go to TechCrunch. Thank you. Okay, so to start the show, I want to maybe start with so Dave, you invest in a lot of like industrial / the most like traditional industry to like add AI to it. So why don't we start with like one of your most interesting companies? So you have a company that literally like study data on call. So like can we just talk about that a little bit?
What?
Like so the
Volur.
Yeah. So I cannot pronounce it. It was literally French.
Oh yeah. Yeah, for sure. I can talk about Volur, but why don't I just touch on why I invest in this space in the first place? So I grew up in Detroit, Michigan. It's a very blue collar city. I started my career in aerospace and defense and then in automotive, working in a lot of these dirty environments that are super antiquated and ripe for disruption in my view. So with that background, I wanted to find companies that could disrupt or enhance the job that I used to have as an engineer. As I mentioned, I worked in a lot of these manufacturing environments, and the company that you mentioned, Volur, they're applying AI to the meat processing industry. So I can't think of anything more antiquated than that. And we're talking traditional meat industry, not Beyond Meat, not Impossible Burger. This is old school beef and pork. And what they're doing is applying software to the process to allow meat processors like JBS to understand customer demand in real time and respond to that customer demand. So they make recommendations on the most optimal way to cut, sort, and process the meat to fulfill that demand.
That's really cool. Wait, why don't you squeeze in? So I want to make sure everybody is literally in the shot. So, okay. So I think that's actually really cool. Like right now, I feel like I see a ton of like new coming like emerging major firms and like a lot of like big industry players in the VC world. Everybody started focusing on like the traditional industries. And since you went to 250 meetups, why don't you talk about like, what are some other trends that you're seeing in the space? And then, maybe you could also cover like why people start paying so much attention on these like industrial space to adding like, new technology to it. I guess like in the past, like obviously this has been a problem for a while. And then why now? Basically?
Yeah, no, I think it's a good question. And this morning on Startup Battlefield at TechCrunch Disrupt, there was one slide of one company presenting. They were like, AI needs to grow up and find a job, right? Because it's all in pilots. It's all in pilots. You have like most of the AI companies are buried in like piles of pilots, and everybody wants to pilot, right? But then moving into production, that's really the heavy lift, I think. So there's a couple of models. I mean, there's certainly some companies who are senior people who had a company before, managed to raise, I don't know, 50 million right out of the gate, and have sort of the stamina to go through, the CISO security review and actually get into production. But I think that the standard model is actually an open source go-to-market strategy. So those people who I actually see moving into prod, the first are, basically open source projects that are first deployed in the VPC internally, and then slowly but surely have an enterprise offering. So I'm spending, I would say, probably most of my time looking at sort of the open source stack for the AI world, which is sort of the same story as we had it in the previous sort of cloud DevOps interface. Now it's all for AI. Most of them are, multimodal, multi-model approaches. So typically you have, I think the space is going to clear up in the foundational models. I think we'll end up having, the flight to scale, but also the small language models. But I think we'll have about maybe 4 or 5 large foundational models in the end. Once this highly capital intensive war for for training GPUs, H100s and the likes has played out, and then we'll have sort of the small language model training companies, and then we'll have a lot of people on the infra side doing the tooling parts. And obviously the new trend that's emerging now is the entire agent stack, where I also spent quite a bit of time and hosted the hackathon. Dave was a esteemed judge there last minute.
Yeah. I think it's really interesting what you said about where we are in terms of AI maturity. So I think we're at a very important time in AI's life cycle, because I'm seeing exactly what you said. Everyone says that they want to adopt AI, but very few actually have adopted it and put it into production. Based on the numbers I'm seeing, it's anywhere between 5 and 10% are in full production. So I see this as, this is still a relatively nascent new opportunity to take this relatively new technology and go big with it. So lots of room for growth.
Sorry guys. I love that. So you mentioned quickly about small language model. Can you tap on that a little bit, since I feel like most audience are super familiar with large language model, but what is small language model?
So the thing is, there's obviously a lot of ways to get the bang out of the buck. You can do, typical RAG, vector embeddings, fine tuning. I think what's emerging is, especially on the enterprise side, and I had a lot of discussions with Fortune 500 buyers on this, where they're like, yeah, look, we even can't use the enterprise versions of the foundational models, because my organization does not allow me to expose even the most basic prompts to a public foundational model. So they want to do an open source model deployed locally, and then fine tune it and make it sort of usable for the org. And I think it's the next frontier in terms of foundational models because you don't need the $1 trillion parameter kind of models to make it useful for certain workflows. And Dave and I, we were actually, I think you're not in that group of the judges. We were in a different judge group, but but one of the finalists, and we had a special prize from Samba Nova, the ones that the guy who actually won that project prize. He came up with a pretty sleek way of fine-tuning on a certain corpus of corporate data to make it usable in the enterprise. And I think that's a space that's I think there certain VC firms have placed their bets in that area, but I think it's one that we'll see more activity in the next give or take 12 or 18 months.
I wanna maybe like double click on like, you mentioned about like these like Fortune 500 companies that are trying to leverage AI or like data to kind of um, innovate within their companies. And I wonder from evaluating startups, this is like a question for the both of you. What does the diligence process kind of look like from, let's say you go to like a large buyer, like a Fortune 500 company? How do you gather feedback that's kind of valid for you to invest or not? Like, since I feel like a lot of people do the diligence by just chatting with, call it like, I don't know, like Delta Airline to be like, hey, would you buy XYZ? But like, I feel like a lot of the startups were in the fairly early stage. A lot of
Mhm.
people take a forever to like get a design partner from somewhere. And like after the like designing certain things for over years, and then like the selling cycle is super slow from a
Yeah.
big enterprise. How do you guys like do diligence from for startups while, also staying in line with like helping them landing the bigger clients?
Yeah, calling some of these big organizations and asking them, will they buy it? Like that's helpful, but it's also not the end all be all because especially now where everyone wants to try everything, people will always say like, yes, I'll buy it, but we don't know how long that contract might last and whether it's the right group. And so I think you got to dig a layer deeper and see how much budget has actually been allocated for this type of technology over the long term. And so one thing I try to look for is it coming out of an innovation budget, which signals that it's short term, or is it coming out of some other bucket that might have more resources behind it? But backing up a little bit, I think this is a people business, right? And so a lot of my diligence starts with understanding the founder deeply and whether or not he or she has the right experience in that industry to not just build a robust product, but also to go to market. So, do they have the right experience and the right network to sell into this market? Because no matter what diligence I do, it's still going to be surface level compared to what that founder has done. So I need that founder to really understand it way more deeply than I do. And so my job is to figure out how deeply they understand it.
I think it's a super interesting question in terms of focus of any startup. There's obviously the much sort of almost it's almost a bit of a VC meme that many of the YC companies are selling to one another, right? Which is I think it's a good start, and we know that that's how Stripe got it starting, and there's many success stories, but I think finding sort of a repeatable mostly homogeneous customer persona early on can be the unlock from whether you graduate from the seed to the Series A and onwards. And so I like to see that founders have done their domain experts and can really educate me on the space that they're selling into and the budgets they're selling into, and or they've sort of done those customer discovery calls where they've specced out I think the worst kind of example or worst kind of founders, they just take intro calls left and right just to add logos for demo day. I think that's a recipe for maybe getting some Dr. Angels on your cap table at demo day, but it won't really carry you forward because it's just not a repeatable sales motion to begin with. So and the thing with AI companies, those pilot returns, they look amazing, and I've heard people who are like, I mean, that's basically that's like 10x what they're used to from this vertical SaaS kind of sales pipelines. Because to your point, Dave, everybody wants to try it out, but then you have to go deeper and really look at the cohorts. Potentially do customer calls, but also do with existings, but also do sort of the reference calls on alternative products, because most of them are actually piloting with 3 solutions in every little subsegment, right?
That's such a great point. And, there are silos within every organization, and those silos don't often speak to each other. Each of those silos might be working with different competitors. So it takes a lot of work to understand, okay, is this a real relationship that is going to last over the long term? Or are they just trying out this product while they're looking at 10 others, and they'll make a buying decision that's real sometime later?
Totally agree with you both. Okay, so quick question on this is like such a different topic, but while I was listening to your the other podcast you went out for like the 75th time. You meant like, so basically you guys only follow, but you don't lead.
Mhm.
So can you share with us more about like, why is that choice existed, and then like, how is it kind of like benefit from like an investor perspective to follow? But I feel like follow would be like really actually hard because of like, to a degree, like if you want to get into the most competitive deals, like
Yeah.
I feel like it could be a lot of competitors to trying to get into the hot deals. What's your thought process on like, figuring out what would be a good company to invest in, and then like how does a follow strategy kind of like plays into the game?
Yeah.
You could chat about this too.
Yeah, so our decision to follow, not lead, was mainly as a result of us being on Fund One
Mhm.
and being a small, scrappy fund that's trying to build a brand and a reputation for ourselves. So for Fund One, we just want to we want to back great founders in spaces that we have conviction in, that we think are going to lead to value creation over the long term. And so, no one knew what Beat Ventures was 3 years ago because it literally didn't exist. Where we had, you have all of your best firms right here in Silicon Valley that we want to invest alongside for Fund One. Like at some point in the future, we would absolutely love to lead, but that's probably a Fund Three discussion, not a Fund One or a Fund Two discussion as we're building a name for ourselves. Now, the other implication of that is, can we make our fund model work with our ownership targets based on a smaller check? And without getting too much into the detail, the answer is yes. We don't have to own 15% of a company in order to provide top tier returns for our investors. And we've proven that over Fund One. We're a top decile performing fund. And we intend to do the same thing in Fund Two.
Yeah, I mean, I just concluded on an angel investment this week, which was probably one of the hottest AI deals. For every firm was after them for 6 months or so. But obviously, like for a small angel check, you can't lead. And I wouldn't say it's following, but it's basically knowing your space, and the problem I see with a lot of emerging managers is that they want to lead Series A's even at the first fund. And to Dave's point, that's probably not a good idea. It's probably showing that you can get allocation into highly competitive rounds, that people see you as a value add. Whatever gimmick it is that you provide, there's all sorts of emerging managers that have engineering experience, that have marketing experience. There's all flavors of that. And I was hosting GPLP meetup last week, and everybody was basically different, offering something different on the emerging manager side. And so sometimes it's network, sometimes it's domain expertise, being a repeat founder in sort of a vertical. In this case, so my angel investment, I can't talk about the company yet, but the founder basically was a speaker at one of my hackathons and really got a lot of value out of that participation. So in terms of early users, user feedback, GitHub contributions to their project. So I think that was sort of the angle why I got a little bit of allocation, which is obviously, angel allocation is not the same as a emerging manager fund allocation, but nonetheless, I think playing that friendly check at the seat is a good strategy.
Totally. I have like two separate questions. One is like, I feel like building up the expertise. Like, so for example, like you mentioned, like there were some people that are doing marketing, some people are doing like a repeat founder. So there's a lot of like different niche that you could go into. Like, in your opinion, like as a person on the cap table, like what would you want the other partner to offer? Either like a smaller fund that coming into the game, and obviously different people have different skill set, but like I feel like I would argue like among all these different skill sets, like one or two would be like the most valuable. Like if you want to pick like a partner to invest with you, like what's the niche that you would pick? And I will save the second question.
That's a great question. I'm not sure I'm going to have a perfect answer for that because it all depends on the deal and what gaps I identify in the startup and what they need most. For us, we try to respond to the needs of the company. So that starts with listening. Um, uh, uh, Vinod Khosla has a great quote that most VCs add no value, some VCs add negative value, right? So our philosophy is first do no harm. And focus on the things that we truly know that where we can be value add. So, that for me tends to be leaning on my engineering experience in these hard industries and calling my network to either be a customer or at least provide some advice. And when I think about the partners around the table, you know, some VCs have a great brand, and that brand is going to be helpful in further fundraising and recruiting. Beat Ventures is not that yet, right? So we have to get scrappy. We have to understand deeply what the needs of the startup are and react appropriately. And sometimes that means I'm a therapist. Right? Yeah.
What's wrong there?
Yeah. Well, I mean, because going from 0 to 1 is really, really difficult. And I want to be a good partner. And that doesn't mean that I know everything and my expertise doesn't span every industry. But if someone feels like they can give you a call at 11:30 p.m. when they have no one else to call and they're dealing with a problem, and I'm just going to help you whiteboard a solution, they know that there's a whiteboard right here that we can hop on. But I think that's a big part of being a VC is being able to listen and respond to whatever the needs are, as opposed to prescribing something or being a think boy on Twitter. Right? That's not us at all. So yeah, that's kind of how we think about it.
Yeah, I mean, look, there's so many strategies about this, and we all know Harry Stebbings, who has this great network. He's playing that to the entire advantage. I think at the seed, the main job is to help the founder succeed and graduate to the Series A. There are certain funds like an SV Angel that had like this whole philosophy, Ron Conway, about passing the bucket to the next, and sort of when he made an intro, it was typically just meant you got a call as a founder. There are different ways of playing this, and it can be that you make the product better, that you get them customers in, that you have a good network with follow-on investors. It can be all of the above. So I think being clear as a GP on what sort of value you want to offer and where you sit in the cap table and are complementary to maybe a competitive round, I think that's really important.
I can give you a few specific examples of just in the last 12 hours, some of the requests that I've gotten. Real time. So I got a request for how do I handle this PR strategy? I just closed a big deal. And I want to make an announcement jointly with the organization that I just partnered with. Do you have some PR firms that you can point us to? And we pointed them to some PR firms, and we're going to strategize on what that PR strategy is. I don't have that expertise. My partner, Colin, who's based in New York, has some great connections in PR. Right before you walked in, I got a request to, do I have any experts in my network that know how to sell into insurance? Like I've talked to some insurance people, but I'm not an expert. Oh, perfect. Yeah. Send them my way. But I contacted 5 people, and one got back right away and not only said I can help with that insurance, but they also said, this looks like an interesting company. I might want to fund them. So it can really span the gamut. And then there's a company raising a bridge round where I'm going through the deck, and giving some advice on how to position that bridge round. So yeah, it really spans the gamut.
I wonder, I really love that. I feel like a VC having like a really solid network is like one of like the must have. And I feel like you both have amazing networks. And I know that you host a lot of dinners and then you host a lot of hackathons. So why don't we talk about like, what are something that you would actively do at these events, and like what are some, I guess, like would you say there will be like a data driven outcome that you're hoping for from like these dinners? Like, I've definitely seen people would track, let's say, 30% conversion on like I don't know, like a dinner to like founder introduction, right? Or like there will be some sort of like actual data to look at. Since like, yeah, would love to hear your guys' answer on the networking slash
I
data.
mean, look, hackathons are they're a headache, and I'm really lucky to be part of a group of people organizing this as a team, right? So there's so many aspects of it, starting with the sponsors, right? That's probably the hardest to crack, and we've probably gone a bit overboard with the sponsors. For the last hackathon, it was I think like 20 or so. We had 25,000 plus in prize money, and then like depending on if it's a cash prize or it's a prize in credits, you have specific sort of prizes, and we had like I think 7-8 specific prizes.
Oh, by the way, if you have more sponsors, you can sponsor our event by being our sponsor when you sponsor.
I mean, I think that's probably the hardest nut to crack in the beginning. And then it's also about location. And then obviously here in San Francisco, I mean, the last hackathon, which was on a Sunday, we were competing with 3 different hackathons. We were competing with yeah, and so getting sort of that community of people, of developers who know that this is a good hackathon. You have to have some cash prizes, because otherwise, unless they really want those specific credits of that vendor, they're not going to show up. And then I mean, the last time our location, I mean, we were just overblown with, registrations. We had like, I think like 450 people turn up, 700 registrations. We were overwhelmed. The space was, like bursting with people. It was steaming hot, right? Really apologize for that. We were both dying there. So getting these different elements in place is really difficult. But then I think the data part that you mentioned, it gets easier with every single event you do. It gets much easier because you have a mailing list, you have sponsors in place, you know how to pull it off logistically. So yeah, I think it's just a matter of perseverance.
I think the heart of your question is building community, and how do you leverage that community and measure that community? And, on the one hand, I know I should be measuring the impact of the communities that I've built or helped to build. On the other hand, I feel like doing so in real time makes it feel contrived and transactional. And that's the opposite of the type of investor that I want to be. I love building community. And the reason is because I think that it increases the efficiency of the market. And, like people want to do business with people that they trust. And trust is a factor of consistency over time. And so a lot of the community building events that I do are an excuse to spend time with each other so that you have the trust once you find a deal. So like you had brought up one event that I do is called Investors Table. I started it with 2 friends, Andrew Rubenstein from Shorewind Capital and Sam Hong from BMW I Ventures. We started this dinner around my dining room table with like 8 people. And now it's grown to around 100. We have a bunch of sponsors. Silicon Valley Bank has been amazing. We just did one last week at the Silicon Valley Bank Experience Center, and we aim to do a big one quarterly. And that's just an excuse to bring people together so that we, have some context for, connecting and understanding around the business that you will eventually do together.
For sure. I really love what you said about like just like building trust, because that's kind of like hard to measure when you are like surrounding yourself with people. And like I feel like even like the mailing list, there's like, some people you have deeper relationship with versus like some people are more on the surface level. I wonder when it comes to like I guess my question would be like, turning them into like a business relationship. I feel like a lot of people you could be like amazing friends with, but like maybe there's like a hard to like find like an overlapping ground for you guys to collab on the business level. What's your thought process on like, turning that into actual maybe like GPLP relationship or like investing in startup, like that kind of like business collaboration? Like I guess like just curious, like what's I guess if there's like any tips or things that you would do to like
Mhm.
measure if there's like any business connections towards a relationship?
Yeah, I think if you do it right, it shouldn't feel like a change at all, right? Like it should not feel awkward. If you're getting to know someone as a friend first, then once there's a business opportunity, like we might have an opportunity to co-invest, then we're just continuing our relationship. One example I'm thinking of is my wife. This might sound a little weird, but my wife and I have known each other since high school, and we were great friends first. And when we started dating, it didn't feel awkward. And when we got married, it just felt like a natural progression of our relationship. And I think there are some similarities in how you should think about those business relationships. Like Erasmus and I have known each other for what, 2 years now. And we haven't done any direct work together other than attending each other's events. But if we were on a cap table together, there's not going to be any awkwardness because we have that foundation of friendship and trust. So Erasmus is someone that I would welcome the opportunity to work with. And that is only because we spent a lot of time together beforehand.
Yep. I'm gonna tout your horn because you're too humble to do it, but the investor table, it's one of the best meetups in town, and I've been to enough.
Thanks, I appreciate
We've clarified at the top of the show. I think what sets it apart is just as an open source, I measure the value on how much value does it add versus how much value is captured, and the bigger the delta, that's what I call actual community. And it's the same with open source. A lot of those open source projects, they're used in every organization, but they capture only a small sliver of it. Your meetups are just like that. It never feels forced. Like not a single conversation feels forced. It's not like I've been to many of these, hosted enterprise events where somebody's trying to sell you something. You sit down and you're stuck in a conversation. Yours, it's always everybody's allowed to butterfly around. You come out stronger, and yeah, I've had a lot of great relationships come out of that. So thankful for that. Maybe on my hackathons, it's basically, one angel investment came out of it, but it wasn't like I was looking for it. I didn't know that person would start a company. It was not public, and it just naturally evolved. And so sort of having this this opportunities surface level, right? That you allow yourself to get lucky. I think that's what it's all about for me.
Just one last thing to add there, because I love that you brought that up. There's this concept of guided serendipity, right? It's like just putting yourself in the right arenas, the right rooms to allow serendipity to happen. That's kind of what I believe in. That's the fundamentals of building community for me.
For sure. I want to learn more about maybe let's take it back to your first dinner or your first hackathon. Like, how did you kind of curate who shows up? Like, I know this sounds like such a nitty gritty thing to do, but I feel like it was always the first thing that kind of shape the whole event or the whole experience for people. Would you curate a specific type of investor? Let's say everybody from deep tech, founder investor, all that kind of stuff, or would it be more of let's have 5 of my closest friends? What's a vibe there, and then how did it evolve into like you mentioned a recurring community of 100 people shows up every time? That's everybody have a great time.
Yeah, I think if you look at the 3 co-organizers of Investors Table, we have overlapping interest, but also points where we diverge. So I focus on AI and legacy industries. I don't want to butcher the other two's focus areas, but BMWI Ventures kind of speaks for itself. You can look at their portfolio. Same thing with Shorewind Capital. So there's enough overlap to where we have an intellectual curiosity that we can discuss. But we also are bringing in these different concepts to the conversation based on our own experiences. So when it comes to curating, especially smaller dinners, we want to replicate that same type of feeling, right? Where we have enough overlap to where we can agree on certain things, but then enough differences where that's going to make things spicy and interesting.
For me, I more or less stumbled into the hackathon hosting business. by competing in a couple of them. And like it's a great way to get to know somebody in a really short period of time. If you actually do the 24-hour, 48-hour hackathons, and you actually try to go the extra mile, getting a project from zero to a working demo, that's amazing. And so some of the people that I run the hackathons with, we were like competing, winning. We had one amazing hackathon with the defense hackathon at Check 15 early this year with
Oh, I know the winner. So
Yeah.
there was like the
it was
drone
all drone
company.
companies.
Yeah, it
We
was
had no
so drone
chance. We had no
companies.
chance. But we worked through the entire night, came up with a wonderful project that, the NSA told us they would buy it tomorrow, but so I think it's like these experiences where you start knowing nothing about sort of the little segment that you're trying to solve, and then you come out 48, like the weekend is over and you've worked the entire weekend on a project with people you didn't actually know at the start of it. So that experience really wanted me to give that back as well, and be part of some of these great hackathons.
I wonder, this is so much of a big jump. I want to talk about like portfolio construction. I know this is like such a huge jump from like the networking thing. I wonder, so like, there's like two school of thoughts. Like there is the high concentration approach, and then there's like the number scheme approach / like spray and pray. Like for your first fund, what's you guys like thought process on like which way should you go after? And in terms of like follow on, not like follow as a strategy, but like follow on like runs, like the later runs, how much would you save to cover, like do you cover everybody who raised to the second round, or like how do you think about like from the return perspective portfolio construction?
I'm going to give a bit of a cop-out answer. I think there's a balance between those two strategies that makes the most sense to me. I think your fund portfolio has to be big enough for the magic of diversity, diversification across a portfolio to happen, but small enough for the partners at the firm to be as hands-on as your portfolio companies need you to be. So for us, that's between 20 and 30, roughly 10 to 15 per partner. And that's where we find that there's enough, because we're writing 5 to 8 checks per year, and there's a graduation rate. So some companies are going to graduate to seed and Series A because we're getting involved at the pre-seed. At the Series A, they don't need us nearly as much, and so we're hoping that graduation rate funnels some companies out, which it's starting to happen with our portfolio. And we're bringing in new companies that are going to be much higher touch at the same rate. But at the same time, we've read a lot of data that shows the larger your portfolio, depending on check size and overall fund size and everything, the larger your portfolio, the greater chance you have to generate top tier returns. So again, like, there's definitely like, and I've heard that the optimal point is somewhere between 40 and 50 companies based on a lot of the data that I've read. So being closer to that 30 still allows us to be high touch, but gives us, an opportunity for the magic of diversification to happen.
The three of us, we met at the last time we met was at the 500 global demo days. And I remember back in the days.
Bowling thing.
Oh yeah, that's right.
Oh, that's right.
That was the latest.
That's right. Oh, that was the latest. Yeah, but I remember this piece. I think it was written in 2015 or so by Dave McClure, who started 500 Startups. And I mean, I think it had like sort of VCs have a lot of should wear 500 hats. That's why he called it 500 Startups, to have like that model of highly diversified.
Oh, I thought it was because you invested 500 companies.
No, that was sort of that was the idea, that you have a highly indexed sort of early stage portfolio so that you can capture the outliers and put in as little as possible. But there, the offering is very clear as an accelerator. You spend the 3 months and then you're off to the races. Everyone is for him and herself, and you're not going to sit on the board of that company. But I think as an emerging manager, the way you stick out is I always say it's doing Series A work at the seat. That's when you actually can show that you have above sort of top percent, or that you have top percentile graduation rates. When you get the founder to that state, then they can graduate to the Series A. I think the puzzle here is really how do you time it? Because if you go really early, if you go pre-seed in the beginning of your fund, that just takes a long time. So I always say start out doing try to balance out the J curve, right? Go a little later with your first couple of investments, and then basically do the really early stage ones later in the fund life deployment cycle. So you get a bit of uplift early on, have some good markups on early markups as you're going from first close to final close, because that's what a lot of LPs like to see, the immediate markup. But it always depends on, certain fund managers don't like to raise for a long time, and they want to do a one and done sort of concept fund. But for the others, I would really strongly recommend you do you bring in if you want to do in an early stage fund, a Series B, Series C sort of flyer ticket, do it in the beginning of the fund to get this immediate markup. That in the last close you can show, I don't know, 1.5x whatever that people get. Obviously have to pay as a late LP. You have to pay catch-up interest, but apart from that, that can be really attractive for some LPs.
I wish I'd heard that advice when I was getting my fund off the ground. We did the opposite, and we did the opposite, and it took a while for a lot of our companies to start to graduate. And now that we're 3 years into our fund life cycle, we are seeing a lot start to graduate, but it took a long time. But on the flip side, I've heard the opposite too, that those first few investments should reflect your overall strategy. And if you start with investing in some of the late stage companies, then what are you signaling that the rest of your portfolio might look like? So there's always a balance.
Good point.
I wonder, so for the people who are listening who are emerging fund managers, they don't have a fund yet, but they're actively raising. I feel like they're definitely seeing you guys as a real motto and or mentors. And I wonder what would be your advice for them? What are something that people may not know until they enter the game?
That's tough. I mean, there's so much.
I'll let you tee it off, but I mean, I think it's always it's similar. Being a founder of an emerging manager is similar to being a founder. You have to know which budget you're selling into. So try to get to know the LPs, and it's a very opaque world, right? But be realistic for fund one that it's going to be mostly high net worth individuals. If you're from a pedigreed firm, you might get an endowment at fund one already, but otherwise be realistic. Think creatively. Also think about sort of corporate buckets that you might have as sort of a strategic angle. They might take a flyer anchor check in a fund one. Build these relationships, track them well, and actually take notes. And every time you pitch the LP, you show progress, because LPs, just like VCs, they invest in lines, not dots, right? So they want to see, they want to meet you typically 2 or 3 fund cycles before they actually commit. So that would be my advice.
Yeah, I think it's a really challenging question, because I've learned so much since starting my fund. There are a lot of similarities between being an emerging fund manager or founder of a firm and a founder. There are definitely some key differences, but one of the most challenging thing for us was understanding who to listen to, who to take advice from, because everyone, based on their own bubbles, has a view on the world that they are going to try to impart on you. And in the early days, we allowed every piece of advice we got to shift our strategy a little bit. And I wish we had been a little bit more
Oh,
stronger willed.
This is such a great point. I feel like you would also get like two different advice from like the south and the north at the
Totally.
same
You get
time.
conflicting, like completely contradictory advice. And there's no malicious intent. This is based on that LP's experience that, oh, you should do it this way. Even what I just said to you, you know, about writing those first checks. You know, I've heard the opposite side of the coin on every piece of feedback imaginable. Or at least it feels that way.
What do you do with it? Like, how
Yeah.
do you like? Do you just listen to like whoever you like, or like whoever gave you money first, or like what's the advice?
No,
you
it's forced me to really understand who we are as a firm and to have a clear view on why we're making those decisions. And if that means that an LP is not going to be as interested, that's fine, because this is our strategy for the firm that we're building. Now, there is definitely some leeway because we want to evolve as a firm. We want to get better as a firm. So there's like the 80-20 rule, right? Where I'm probably going to ignore 80% of the advice that I get, but then be open to changing my strategy on that other 20%.
Yeah. And that portfolio construction thing. Funny story that I'm not sure, but I think the audience will like it. But I read up on sort of Andreessen Horowitz Fund 1. And you know what they did at Fund 1? They actually placed a quarter of that entire fund into a Spotify deal, a buyout deal with Silver Lake. Like completely off strategy, but it was a late stage deal that I think in a matter of, I think it was like 2 years, 4x'd and you know, provide a good baseline return, high IRR, off strategy, but still, you know, there's so many ways of, you know, looking back and going through those portfolios of those early managers. Some of those look, you know, probably at the time when they made the investment, the LPs must have been scratching their head and be like, yeah, what did I just back? But I think in venture, it's like always, there's so many ways to be successful, and it's a lot of it is random in the end, right? So try to, as an emerging GP, try to find something that you can be high conviction on. The reason they made this investment was because Mark Andreessen sat on the board of Facebook, I think, and they had like a integration with Skype planned and Facebook at that time. So it made sense. It was a high conviction investment, right? But you have the freedom as an emerging to go after what you know is, you know, has potential, and just looking back, you know, make sure that it's like something that you feel comfortable with defending at fund 3, 4, 5.
So you're telling me I should have made that investment into NVIDIA stock when we started our fund, because we'd be doing pretty darn well right now.
That's a good one.
I think that's some really great insights, but like I feel like, but as a first time fund manager, there may be like a lot of moment that you're reflecting on your strategy to be like, is this like actually gonna be able to pull off? And like I guess another part is like I feel like as a earlier stage investor or angel investor, like you don't get a lot of like visibility into the company. Like the company could just, you know, sometimes they update you if they thought about you, but like or like even when you are chatting with them, you may not really get the level of diligence like visibility that like the later stage funds. Like how do you solve the problem of like if people, you know, give you something but it's not like everything, but like when you ask a checklist you feel like, oh, should I ask them, like what if they don't give me anything? Like, you know, a lot of people would be like, oh, we just don't deal with a company that's behaving that way. But on the other hand, like, you know, some of the hot Silicon Valley companies, like they are kind of um you know, they are kind of like behaving like they actually don't care, but on the other hand they may be like a really good company to invest in. Like what's your guys thought process on like dealing with the FOMO or like dealing with like the fact that
I don't really deal with FOMO as much, not nearly as much as I used to. I mean, it's always going to be some driving factor in the back of a lot of investors' minds. But I've learned to really trust my own conviction and to build my own conviction over time. In terms of, you know, visibility into a startup, there's definitely always that risk that you're going to invest in a company and they're going to disappear on you and not communicate. Thankfully, we haven't had that issue yet. And I think it has to do with our selection process. The fact that we do spend quite a bit of time before we make an investment. We have a good foundation of trust. Again, going back to trust, we have a good foundation of trust to where, I'd like to think that our founders want to hear from us, and they don't have a problem checking in every so often. Like, we will do monthly check-ins with most of our companies, but some of them, they don't need to check in that often. Which is great, and I think it's great until it's not. Right? When things are going well, then and you're growing crazily, then maybe you don't need your investors as much. It's when things start to go a little awry that you're going to need us, and that's when you want to rely on that relationship.
It's certainly easier if you're angel investing and don't have fiduciaries to answer to. So there you can really go on, do I want to be part of that journey, and write it off already, because you're not going to see that money for another 5-6 years anyways. So just have that in your sort of personal cash flow planning. One reason why I like open source, commercial open source companies, because you can actually do diligence pretty easily on their GitHub repo, right? Have they actually committed? Is it just the core team committed? Is there a community doing outside commits? You can run that pretty easily, and vet people this way, right? But yeah, I mean, to your point, obviously, if you're writing friendly participatory check, you can't you can't send them ESG questionnaires and long DDQs. Your allocation is quicker out of the window than they answer sort of the first question on the double glazed windows in their offices in the ESG questionnaire. No, but it's I think it's really know what you're working with and know what you can ask of founders, right? I think we had some really shocking examples of lack of diligence by some marquee names with companies like an FTX, where I think FOMO was a big part of it, right? But I think knowing in which market environment, and I think that's sort of the big benefit of this market environment, that you have more time in the traditional fundraising cycle than in the SERPA 2021 area, which was there was a lot of people taking flyers on hot companies.
I have a quick question. Oh, by the way, I want to be mindful of time. Can we go maybe a few more minutes?
Yeah,
okay, perfect. Yeah. So I have a question about the psychological part about LP. So I feel like for VCs, there's obviously FOMO. I guess because we're currently in a down cycle. I wouldn't say I don't know if we're actually in a down cycle, but we're not in the most active cycle in terms of deploy capital from LPs or everybody. And what's the psychological reason that they would believe someone would actually help them make money, besides there are some obvious pedigrees or a past track record, but that honestly doesn't really reflect on who will behave well later, because a lot of it are depends on luck or some other factors. When people are actually successfully at raising or deploying, what are some common patterns of their beliefs on the market or particular people to kind of invest in these people.
Are you asking specifically for LPs investing into GPs?
Yeah. Okay.
I'm not sure. I'm not an LP, so I'm not sure I can speak to that perfectly. As much as I like to think that FOMO doesn't play a role, I know I just said that, FOMO doesn't play as much of a role. That is in comparison to when I first started at investing. I feel like I am able to suppress my FOMO enough to check the right boxes and run my process. I've built a lot of empathy for LPs since beginning this journey. And what I mean by that is I have a better understanding of how difficult their jobs are. Because when I think about my job as a GP, I write a check into a pre-seed company. and I can go through, a few months of diligence before I write that check. And then when it comes time to raise that seed round, if I want to follow on, I can go through another month or two of diligence to make another decision on whether I want to double down, and do the same thing in the A and the B, depending on my fund size and strategy. Whereas an LP has to make a 10-year decision at the very least out the gate. So I don't think that the same dynamic of FOMO is played in making a 10-year decision. And in some cases, that's decades long, right? It could be fund 2 and 3 and so on. And you have to make that decision on that first check. So that's why track record matters a lot more, because they need to see that you have done this before, that you've demonstrated a track record of generating returns as one predictor of future success. It's not the best predictor, but it's one predictor. So when I think about the LP's job, I think, the history of that GP matters way more than when I'm making a decision to invest in a founder.
Right.
Yeah, I mean, there's a lot of upfront diligence on the LP side. I had dinner with a major LP yesterday, probably the most aggressive and outspoken LP I know. He was like, if I don't get a 5x out of manager, I'm not only going to not re-up, but I'm going to call all his existing ones and tell them to drop. Because he's like, we're living in such a bubble where everybody has forgotten why we're investing in venture. It's for outsized returns, not private equity returns. We want to have outsized returns and have managers shooting for that. But obviously, it's like all honesty, how much can you actually influence it? You're still like, even a GP is still a capital allocator. The people running the show are the founders, and it's like I always have this analogy. It's like the stadium, like a football stadium. The founders are the players on the field, GPs are the coaches, and LPs are like the stadium owners, right? How much can a stadium owner ultimately do for the outcome of the game, right? I mean, ask Mark Cuban. He's getting the best coaches in the house. So I think choosing the right GPs is certainly one factor. But there's so much upfront diligence needed to invest in that blind pool that typically what I see LPs do is they want to see that there's sort of a repeatable process in place. Oftentimes fund ones are the easiest because you're basically investing out of your existing networks. Fund 2 is where you have to show that you have sort of a motion to repeat, to get deal flow repeatedly. And then fund 3, when you start building out a team, you need to show that you can actually build a platform and a team. And some people like to stay small. Some people also don't want to have permanent. We've seen a lot of VC firms shutting down voluntarily or having only internal vehicles. So there are many factors to this, but I think the most successful platforms, they've sort of built this motion of knowing when to pass it to the next next generation, and sort of knowing sort of how big is big enough, and when is it surpassed and when is it a different offering also to LPs. But yeah, it's an interesting, it's a jungle. You have the emergings, you have the large platforms, you have the up and comers. It's always a big jungle, and then you have obviously the LP world, which is completely heterogeneous. With certain endowments suffering still from the denominator effect, and other ones fully ready to deploy. And then within venture, you have this dichotomy of AI, which is booming, and then the rest, which is some of it is still growing into the valuations. Some companies have like great underlying kernels, and it just takes them a year or two longer. But I think we've seen austerity measures on the one side with the existing highly funded SERPA companies, and then full-on expansion mode with the AI companies.
Can I ask a follow-up question there? Just curious, Erasmus, if you were to start a fund today, you mentioned that there is a fund size that is too much. You have to know how much is too much, and how to build a team. Like, what do you think is too much in this environment, and how would you go about building a fund?
I mean, look, it's
That's not great.
that's a great question. I mean, I always say there's like three archetypes of emerging managers, right? There's the spin out, sort of, you know, you're out of a pedigreed platform, you're spinning out ideally with a team. But then you have the complication that basically, can they do Series A's without, you know, the Sequoia and Andreessen, whatever brand name? Then you have, which I think personally is the easiest to underwrite, sort of the angel turned GP, where you have people who've done angel investments and they've, you know, shown that they have a network, that they can get access, and all they have to do is etch up the fund, sort of the check size a little bit for institutional fund size. And then there's the founder turned GP, which is a pretty hard one to underwrite, because a lot of founders, they like the idea of being an investor in a VC and pulling the shots, but then the day-to-day of dealing with LPs, they don't actually like that much. So those people, I typically tell, why don't you do a side fund next to your startup first, you know? So I mean, there's not the golden or the magic bullet to it, but sort of knowing what you want to do long term, because it's a long-term game, right? If you then have to shut down a side fund, that's, you know, like you're buried in tax questionnaires for the next 3 years of your IRS life, you know. So make sure what business you want to be in, and then execute well on it.
Yeah, I hadn't quite realized how much patience was involved in being a fund manager, because, you know, I was used to being an operator, and being an operator, it's, you know, you have to do things on a daily basis to move the business forward. Whereas with the fund, I mean, there's definitely some of that, but a lot of it is you have to be patient and wait for the right opportunity to come. And when the right opportunity comes, to intensely attack going after that opportunity, be it on an LP side or investing in a founder.
I have, which bring me to my last like real question. I want to be mindful of the time. I don't want you guys to be like, let's leave. But anyway, so I wonder, when it comes to thinking about building a fund, I feel like right now I've seen there's like two part goes into my thoughts. Like, one, it's like what you said about repetitive advantages that like the GP can always play to win. I just personally feel like as a like potential like wannabe emerging manager, I always think about like, you know, what is something that I could like, I find my own like product market fit in the ecosystem to like really pull off something big time for like the next 10 years. That's kind of something that I've been always like challenging myself on, like thinking, you know, what I could do like that nobody else can do. But obviously I've seen like other people who have no trouble like just starting. Like obviously I feel like they may not really think things through, but like they started early, so they may have like a more of an advantage. I wonder what's like the suggestion or like the perspective, since like the both of you are a lot more experienced, like what's your thought on like, you know, the doing or like finding the product market fit and go hone in on that. And the second part of the question is about like fund building. So I've seen like a lot of like the emerging managers, I think they're great like solo artists. So I call them artists just because like I feel like a lot of people are actually having deep understanding in particular market or like domain expertise, or like call it like marketing or like operator, or they have like a certain amount of background that just make them really stand out as like the first time fund managers slash like entrepreneur of a fund. But I don't think there's a lot of longevity in some of the people that I'm like, are they going to be the next A and Z here? Like, I don't think so. And I feel like there may be like a merge in the ecosystem in the next like call it 10 to 20 years. But I actually don't know. Like, since like, I mean, I'm just like I can't really predict the future, but I'm just like observing the ecosystem. That's like things that I've been thinking about. You know, and obviously there's funds that are trying to do secondaries of not secondaries, but like maybe like leveraging these like, you know, the emerging managers slash like the investor artists, like their location or pro rata to like just like take care of it from like raising a bigger fund, and then like just do these like full off these like top emerging manager deals. Wonder what you guys thought on like these kind of funds too.
I can take the first question on thinking versus doing. So there's definitely a balance. I feel like, so I've seen both, where you jump out a little bit too early and you start doing, and there's a failure to launch. And then I've seen the other side where you think a little bit too much and there's also a failure to launch. And so I don't think, I think that you learn the most by doing. And some of the advice that we got early on were from people who started firms a little bit too early. And once you're in business, like, you've got to figure it out. Right. So there's a good argument that we got started a little bit too early. And I've learned so much along the way, but if I had just been thinking about it the whole time, then I wouldn't be where I am now. So I'm definitely slightly more in favor of jumping. Yeah, jumping and figure it out.
I have a quick piggyback question on that. Like, what's the motion of jumping? Like, what's your like self-convincingness to yourself on like, I can actually do this, versus like you're like, oh, am I like so delusional? And like, because I don't want to be in debt for like $20 million if I invest in like the wrong thing. So I know that sounds like so naive or like so like ridiculous, but like I feel like I want to be able to sleep and like know what I'm doing, like fully, like have like the full control. But on the other hand, that's not technically venture capital do. So yeah. What's your like like how do you kind of like
If peace of mind is
self-confidence?
what you're looking for, I don't know if this is the right the right industry, because there's always, ups and downs. Sorry, what exactly was the question?
Like the self-confidence slash
Yeah.
like self-convincingness to yourself.
Yeah, I mean, the cycles between the feedback cycles are so long in this industry, right? So you don't actually know if you're good for a very long time. So I would say, like, yeah, start with angel investing and write the angel checks that you can, and prove to yourself that you're good enough to jump out. But more importantly, that you can articulate how you're differentiated, to LPs that you're going to be pitching to. Because in this environment where there's been an explosion of funds that are hyper niche, to very broad. I mean, I think just since I started, it went from, like 3,500 funds to now over 5,000. Like, I don't know how many of those are fund ones or fund twos, if they'll even, get to fund two. But I think that just reinforces this point that you have to be super differentiated and be able to articulate why you're differentiated. So I think it's like a combination of the track record that you've built, however you can, in writing angel checks or, so on, and then having that differentiated strategy that you can clearly articulate to LPs.
I have like this like really like weird thought about like these angel investor become fund measures. Like your angel investment, you have to invest in something like low-key like 10 years ago to like see the like big outcome. But like, or like let's say even you have to, if you want to see any track record or like any sort of like convincingness to like the LPs, at least you have to invest like, let's call it like 3 years prior to this company raise the next round. Like, how do you even know if this thing is like actually like gonna work, like from the angel investment? A lot of people give these advice on like angel investment, but I feel like it's so hard to tell. Like also if like someone just raised like a syndicate or something, how do I know like if this syndicate is actually a good investment? Because like there's a lot of really popular syndicates started by, let's call it, people with great Twitter following. Like a lot of individual investors, they would just really jump in because of like blah blah blah, like tweets are really witty. But on the other hand, like, are they good investments? Like, I don't know. Like, sure, they can like get the crowd to invest something that demonstrate the founder have some sort of like salesiness that like they will be able to sell. But like on the other hand, can they really sell to the general public with no product? To like, not no product. I feel like I'm very savage here, but I guess like you get my point. I wonder what's like the best way to like build a fund.
Yeah, I like your term investor artists, which is I think a great term. And no, I'm always in awe of people who are setting out to raise a big fund, and even if they get to half of it, if they just have like shots on goal, I think that's a great accomplishment. Sometimes it comes out of like people start out of frustration of missing out on great companies. I have one that I met them at a meetup, one of the many meetups I joined in, I think it was like in April 2023, met them, and they were just, coming over from Europe, and gave them a lot of advice. Could have invested. They've got marked up twice by now, and it could have been a great investment already. And so it's investments like that that actually lead to all of this regret that I did not have a vehicle to deploy out of. That I think a lot of angels that I talked to, they were like, oh, I had like 500K allocation into Snap or whatever. And then they start syndicating it out to sort of as a first step to see if they actually want to take on third-party capital to manage, because it's just a different ballgame. So I think it's a very personal decision at the end of the day. In your case, I would probably say doing a couple of those syndicates to see if you're comfortable, finding high conviction cases that at the time they're the perfect pick, and then executing small SPVs on AngelList would probably be a good advice to just test the waters.
You're kind of touching on some perverse incentives in venture, because like some of the incentive is just to get marked up, right? And so like that leads you to invest in the founder that is going to instill more FOMO and act as though they're building a company quickly, right? And maybe attract some, sorry for using this term, but some dumb money to invest, right? To get marked up. And that's not how I think about investing. Like this is a long-term game. And that means that we have to attract LPs that are going to understand that over the long term, we are very well positioned to produce top tier results. And that's, is partially a result of our focus on legacy industries. We know that there's going to be slightly longer sales cycles, right? We know that these things, like we're going to have to overcome some entrenched boy networks, right? But if you build a product in these spaces that you can get traction on, it might take slightly longer, but over the long term, we believe that it's going to produce a lot more value. So I would encourage you to take a slightly longer term perspective. Like don't just chase these quick markups, but instead invest in these companies that are going to build long-term value. And if you really want to be in venture, then what's the difference between 2 and 5 years?
I love that. Also, hi, shout out to Scott. So sidecar for Seneca. Okay, a sidecar commercial. But anyway, so please sponsor us. Anyway, so I wanna maybe like we will just cover like a really quick last question, and then we'll do like 1 minute fire round. Like in your mind, like what does a really successful fund look like? We have the ACZ of the world who's building the world's largest like platforms, and then on the other hand we have like the benchmark of the world, which is like 6 investor against the world. What's your thought on like the future of like a good fund? What does it kind of like entail?
I mean, benchmark, they had the phase, right, at the turn of the century, after the .com bubble, where they were going after like $1 billion funds. They cut that back. They went globally, went locally again. I think it's there's also, once again, there's not really the silver bullet. I think having equal economics, equal partnership, that's an ideal model, but sometimes it's just not the reality, even though you have it maybe on paper. So I think, speaking again about the emergings, I think finding sort of the first couple of GPs that you've done deals with is probably the best if you want to team up, But I've seen really successful fund ones as solo GPs saying like, I can't figure out who I actually want to co-invest with, so I'm going to run it not as a team sport, but as a solo GP for a while. So there are different models there. I'm not sure what your thought process was. Starting out.
So as a fiduciary to my LPs, like my number one goal is to return as much capital as I possibly can by finding the best companies to invest
Sending them
in.
this clip immediately.
And so like if you're asking me to talk about some of the best firms, like Benchmark, I really admire. They've returned a ton of capital. They've invested in some revolutionary companies that are category defining, same as A16Z. I really admire both of those firms. But if I think about the future of venture capital and what venture capital is going to look like 10 or 20 years from now, I think it looks a lot different than it does today. That's partially due to the deflationary effect of AI. how AI
I was expecting
democratizes.
the AI come into the conversation immediately.
Well,
but-
sorry for being stereotypical, but the AI democratizes access, right, to building, and so Sam Altman recently said that we're likely to see a one person unicorn soon, right? If that is the case, then I have to believe that startups are going to need less capital in order to build. And if startups need less capital, then we need fewer VC firms, not more VC firms, right? And we need those firms to be smaller, not larger. Right now, it seems like we're seeing the opposite, right? Like we see GC just launched an $8 billion firm or fund. Great for them, right? I think it's really, really difficult to return a multiple on $8 billion. I would love to be managing $8 billion right now, just for the fees alone. But, my stance as a fund manager is not, raising $8 billion. Like there's definitely some upper level threshold that we would rather focus on. So yeah, I think that we will see way fewer, I don't know about the number of firms, but we will have, in terms of dollar amount per firm, much smaller firms moving forward. And it's probably going to get even more niche than it is today, right? Because if everyone has the opportunity to set up a fund, then, you need to lean into your expertise and add as much
We
value
need a
as you
dog
can.
hair care fund just for the audience who are listening.
But I can also make the exact opposite argument to what I just made, right? And that all of these micro funds, like my own, get washed out and get taken over by the mega funds. Like it's hard to predict.
So Grace, you're gonna launch an underwater weaving fund or
Oh,
or a
God.
dog hair care fund? What's the plan?
Well,
It's your time. Call to action.
Call to action, launch a fund right away. The audience, you're listening. That's a great question. I have to think about it. Okay, so let's jump into the 1 minute fire round. So first question is, what's your favorite book?
You're putting me on the spot. I have to say, off the top of my head, I love The Psychology of Money, by Morgan, forgetting his last name, but he's a partner at a venture fund, collaborative fund, I believe. And I read that book once a year. There's nothing super revolutionary in it, but it just reminds me that, the psychology of money is understandable. And if I can understand that within myself, then that helps me be a better fund manager and also a better dad and a better husband and, how I manage my money.
Stereotypical Harry Stebbings 20 VC answer, Phil Knight, shoe dog. Yeah. And what I like about it is actually that very few people actually have talked about it, is that Nike was actually side-strapped next to his job as an accountant. For like the first 10 years of the existence of Nike, he was basically an accountant at, I think, PwC, and it was like a side project. Nike was his side project next to the most boring job in the world, right? So that's an inspiring thing for any entrepreneur.
Morgan Housel is the person that,
So yeah, I love Shootout too. So what's the I guess the second question is, who made the biggest impact in your career?
I've got to give my wife a shout out. Michelle, if she's out there, definitely, hands down. Yeah, like just having a supportive partner allows me to focus on the things that are important, about my career, and like not having to worry about, the person that is mothering my son and, the partner that I go home to every day. It's really phenomenal. It allows me to focus on all the right things.
I want to give a shout out to my PhD supervisor who gave me a lot of time. And, like there was a phase where I was showing up really late in the office, around 12 p.m. and he never said anything. Or he said something, but he actually accepted it. And I had this, for the first company I started, it was like, like the Yahoo co-founders said when they were building Yahoo, they were actually in their PhD as well. And they said like doing a PhD is like the only thing you want to work on is not your PhD. That's why you start companies. And so he gave me a lot of free time and leeway to work on my side projects. So I'm really thankful for that. He was recently here in San Francisco, took him to dinner, and he's a great guy. Stefan Bechtold at ETH Zurich, if he's listening.
Send these clips, please. Or chop them up in like 70 TikToks. Well, who would you invite to your dinner party?
Dead or alive?
Good question. Probably some of the presidential candidates, along with Elon Musk. Yeah, just for the confusion they cause.
That's a hard question. I know who I would not invite to my dinner party, and it would be the presidential candidates. Man, you're gonna have to come back to me on that one. Sorry.
Oh, wow. I guess we kind of have the both of you at the same party. But anyway, where can we find you outside of work?
So I'm a member of the Dolphin Club, which is the oldest rowing club north of the Mississippi in San Francisco. We do open ocean swimming to Alcatraz, back and forth without a wetsuit. If you're into that, join us.
Have you really swim to the Alcatraz?
I'm still training for that one, for the full swim.
What?
That's phenomenal. For me, I'm a very bad golfer, but I love to get out on the course as much as I can, which is very difficult with a 2-year-old at home. And at the poker table, love a good game of poker.
Amazing. On that note, thank you so much, audience, for joining us. Hi, Scott, again. And thank you guys so much for joining us. It was such a wonderful conversation. Looking out for part 2.
Thank you, Grace.
Thank you.
Yeah, thank you.